Good morning and welcome to our webinar. Today's webinar is an update for charities. Our presenters today, we have James Hurst, our VAT Director, Gareth Burrow, an Audit and Accounts Manager with the practice, and Linda Cooper, who's our Audit Director. The webinar is scheduled to last for 45 minutes. The presentations will last for 40 minutes. There'll be plenty of time for questions afterwards. If you've got a question that you'd like to ask, please use the Q&A facility at the bottom of the screen, and we'll answer as many of these as possible within the time at the end of the webinar. The webinar is being recorded today and will be available on our website afterwards at brownbutler.com. James, can I hand over to you to start, please?
Thank you, and good morning, everyone. So in the first part of the presentation this morning, I'll be spending about 20 minutes with a VAT update and looking at some of the themes that I'm seeing with clients at the moment and some of the things coming out of HMRC. I'm starting off this morning with pulling together a few thoughts regarding some special measures to do with COVID-19. You'll remember last year that organisations could defer VAT payments relating to certain VAT returns in February, March and April 2020. The deadline for making arrangements with HMRC to pay that deferred VAT, the deadline passed on the 21st of June, and HMRC were saying that anyone with time to pay agreement should have sorted that out by the end of June. But if you are in the position of still needing to pay deferred VAT or struggling to pay VAT, we're generally finding that HMRC are pretty amenable at the moment on time to pay arrangements. One of the main measures was the reduced VAT rate of 5% for certain goods and services, including admission to attractions and hospitality, food and drink and accommodation. And I've had charity clients who've been able to benefit from that 5%, although the guidance is pretty sketchy, and there are sometimes questions about whether certain things are eligible for the 5% reduced rate or not, and it's a case of working through that and sometimes seeking a ruling from HMRC. So that reduced rate will increase to 12.5% in the autumn through till March next year. But it does provide some extra revenue for those who've been hit by reductions in visitor numbers. One of the, for me, interesting points from a VAT perspective is where charities are seeing changes to their income as a result of COVID measures and lockdown and restriction to visitor numbers and so on. So we've spoken with a number of charities that previously provided free admission, for example, and have moved to a ticketing system and charging for tickets. And that's partly to control numbers and for track and trace purposes and so on. But actually, there can be a different VAT treatment. You know, if you're charging for tickets for entry, is that subject to the cultural exemption or is it standard rated? There's a different income stream and potentially a different VAT liability and potentially a different impact on your ability to recover VAT. So all of those changes in activities and trying to generate different income can have a different VAT consequence. My final point on this slide is a mention of partial exemption, a subject I'll come back to later. A couple of months ago, HMRC said that if you needed to make a temporary alteration to your partial exemption method, including a combined partial exemption and non-business method, that you could apply to HMRC for a temporary alteration to reflect changes in your trading pattern as a result of COVID and lockdown, and that HMRC promised a fast track on this. All the feedback so far is that it's not a very rapid response from HMRC. But anyway, it's at least that facility is there. Looking on to on my next slide to some other developments over the last few months. One aspect there for charities that are closely monitoring their taxable income as to whether they need to register. We've got some certainty that the VAT registration threshold is going to be held at the current level until at least 2024. Brexit has had an impact in some ways. I've with clients who are importing goods, for example, to support trading activities in a trading subsidiary or something like that. We now have imports are subject to import VAT where goods come in from the European Union, and there's now a simplified method of accounting for the import VAT using postponed import VAT accounting that's generally working quite well. There's some practical hurdles, I think, with import VAT certificates, because HMRC's computer system is groaning at a bit under the weight of all the import entries. But one of the changes as a result of Brexit is, if the other way around, is if you're doing B2C sales of low value goods into the EU. And this certainly applies to charities that have shops, as say a museum with a shop that does online sales, and with the growth of online sales. There's a new system from 1st of July this year that says that you have to account for VAT on an import on any goods going into the EU, or you can sign up for what's called the Import One-Stop Shop, which means a single VAT registration in Europe to account for all of those sales into Europe on a simplified basis. It's not in practice that simplified, in my view, but people like the Royal Mail have started providing some sort of offering. We provide an offering as well to clients to work through how to account for VAT on those B2C sales into the EU. With Brexit, I think there was some hope that with zero rating in the UK, that because the UK would not have to follow the EU as closely as it did previously, that there would be greater flexibility for the UK to bring in more reliefs for charities, to benefit charities, but we haven't really seen that follow through yet, whether that's a result of COVID overtaking everything else in terms of legislation. But I think we remain hopeful that the UK can have a bit more flexibility. But I've put on the slide the domestic reverse charge for construction, just a reminder that some charities that are buying in construction services need to make sure that the contractor gets the VAT treatment right on their construction projects, and also at the end of making tax digital, a reminder that everyone should have gone live with MTD by now and have fully digital links between all parts of their accounting system, and using compatible software for submitting their VAT returns. I think my experience is some organisations still have a way to go to be fully compliant on MTD. Looking next at a technical issue that's been reflected in some recent cases, and not necessarily charity cases, but cases in the commercial world mainly, but do have a significant read across to charity VAT. There's been this perennial thorny question of, if as a charity I have outside the scope income, such as grants or donations, subsidies, and so on, does that lead to a restriction to the VAT that I can recover? And the answer, as a colleague of mine used to say, is a definite maybe. The answer to that question. It might lead to a restriction to VAT, it might not, but it doesn't necessarily follow. And when I started in VAT sort of 30 odd years ago, it was generally the case that a simplistic view was taken that if you had outside the scope income, such as grants and donations, then that automatically led to a restriction to the VAT that you could recover. But actually, in more recent years, the analysis has become more sophisticated, and it's really looking at if you do have outside the scope income, well, what does that income do? What's it used for? Does it support a non-business activity or a business activity, and the VAT recovery ought to be decided on that basis. I'll briefly mention the Frank Smart case because this has been a leading case in this area. It's about a Scottish farm in Aberdeenshire that was receiving single farm payments from the Scottish government. I found the details fascinating personally because it was a farm that was allocated about 195 single farm payment units, which gave it a right to receive these payments from the Scottish government every year in return for maintaining the land and meeting certain requirements for plant and animal health. But then these units became tradable and market developed in them, and they went to the bank and they borrowed nearly £8 million, and they bought up another 34,500 units, and so had millions of income coming in from these payments. And they'd incurred all this VAT buying these additional units. They weren't, and they rented out thousands of acres of additional land to support these units, but they weren't actually farming the land at that stage. But HMRC denied them VAT recovery on the purchase of these units and said, these units, it's an investment activity. You're incurring all this VAT to buy these units for an outside the scope investment activity. But in fact, HMRC lost all the way through all four stages from the first tier tribunal to the Supreme Court. And the court said, no, the purpose of buying these units and incurring this VAT is to support a farming activity, which is a taxable business, and therefore you should get the VAT back. And that's what neutrality means in a VAT concept. But HMRC don't like this, and they don't like this with charities. And they've had another go very recently in the Newell case, which was a biomass business which received a lot of subsidy. And HMRC said, well, you've received all these government subsidies, it's outside the scope of income, you can't have all your VAT back. But HMRC lost that case because the court said, well, it's a taxable business. The fact that it might receive subsidies is incidental to that. It's not a business set up in order to receive subsidies. It's for a taxable purpose. HMRC, I think, were emboldened a few years ago with, about a year ago with this case called Vehicle Control Services, which was a business that you'd bring in to operate your car park. And they would collect the money for car parking, and they would fine people who didn't pay for parking or didn't park in a bay properly. And HMRC won that case because they said, well, that business needs to restrict its input VAT because it receives a lot of fines that are outside the scope. And in that case, you could see that actually that was where the business got its money from. It earned its money not from parking charges, but from outside the scope fines. So, you know, that was understandable. But if we go back to a VAT case in Sveda that came out about 3 or 4 years ago now, this was a European case that's been talked about a lot in the last couple of years. And this was a case where an organisation in Lithuania, if I recall, had a visitor centre with a cafe and shop in the middle of a forest, and they incurred a lot of VAT in constructing a path through the forest that visitors could follow. And at the end of the path, you got to the shop where you'd spend your money. And the Sveda made taxable supplies from that. But to construct that path, they received a government grant covering about 90% of the cost. And the tax authority said, no, you can't get the VAT back on the cost of constructing the path because it's been funded by a grant and people can use that path for free. But the European Court flatly disagreed with that analysis and said, well, the purpose of the path is to bring people through to where Sveda are making their taxable supplies at their shop. And there's a direct and immediate link between the expenditure on constructing the path and the taxable supplies made at the end of it. And it doesn't matter how that path has been funded. So the fact that there is outside the scope grant income doesn't inhibit VAT recovery in that place, in that situation. And I'll come back to that point a bit later on. Moving to a different case, or rather two cases that were joined together. These are a couple of cases, Life Services and the Learning Centre Romford. We're looking at the VAT treatment of care services that come under the exemption for welfare services. Now, neither of these entities, again, are charities, but there is a direct read across with charity VAT here, because these companies were initially successful at the tribunal in saying, we provide welfare services to people in the community. We get paid by the local authority. We carry out our services to individuals under a formal care plan, and we think we should get VAT exemption for these services and not charge VAT. And what the law says is that the supply of welfare services by a charity or a state-regulated private welfare institution is exempt. And they said, well, we're not a charity, we are a private welfare institution, but actually we're not state-regulated, but we should get the same VAT treatment. And the concept of neutrality, fiscal neutrality, means that if we're carrying on the same services as charities, why shouldn't we be treated the same as them for VAT purposes? And the courts initially agreed with them, the tribunal, but now it's come to a Court of Appeal decision that's agreed with HMRC that in fact these supplies are VATable. And looking at that point regarding charities, they said, well, we ought to be treated the same because it imposes a different VAT treatment between charities and other private operators. And it means that charities can get VAT exemption, whether or not they're devoted to social well-being. But the court said, no, that's not the right way of looking at it. There's just because the law distinguishes between private welfare bodies and charities, charities don't have to be state regulated, but in fact, they have to be established solely for charitable purposes. And they're subject to supervision by the Charity Commission. And any reasonable person would see little difference between the services provided by charities and those provided by state-regulated private providers who are regulated, say, with the Care Quality Commission. And in any case, on that point about whether charities are entitled to exemption, whether or not they're devoted to social well-being, well, clearly a charity supplying welfare services must be doing so within their charitable purposes as specified in their constitution. So, that point doesn't apply at all. And so the law said, well, it's if you're not regulated by the CQC in England and Wales, you must charge VAT and you can't have the same treatment as charities. It also sort of reminded me of the case of Chester Centre for Independent Living, I think, to give it its full title, a case that petered out a year or so ago, which I always thought was a very harsh position taken by HMRC, where the Chester organisation was helping disabled people to live independently by where the disabled person needed a carer to come in and that carer needed paying, the Chester would operate a payroll for that individual. And that was something that the disabled individual clearly couldn't do on their own. And HMRC said, no, that service is not a welfare service, it's subject to VAT. And Chester won their case at the first tier tribunal. HMRC appealed and it went to the upper tier. And then Chester at the last minute withdrew from that case. So the court had no alternative but to deem it a win for HMRC, and that set a precedent. And I had a similar case with a client who stood behind Chester, where they were operating bank accounts and making payments for living expenses for people who were incapable of operating their own bank account. But HMRC there argued that it was not a welfare service, it was a service that was subject to VAT. And so even though that meant charging VAT to the disabled person and eroding their income, HMRC stuck to their guns. So it's in this sort of area, HMRC do take a very narrow view. Moving on then to the, well, in fact, going back to partial exemption, which we briefly mentioned earlier, a recent court decision coming out is from the Court of Appeal, is in favour of HMRC in the case of Royal Opera House, who said they were trying to argue that the costs of putting on productions were linked to their catering. So they said our production costs relate to putting on operas. We sell tickets that are exempt from VAT under the cultural exemption, but we also generate taxable income from catering, ice cream, restaurant sales, drinks, etc. And because we've got all that taxable income, that ought to allow us some improved partial recovery for our production costs, because there's a link between the two of them. People attending the opera spend money on catering. But the court disagreed, and they said there's only an indirect link. People don't go there for a meal or for drinks and say, well, oh, we'll pop in and see a bit of opera whilst we're here. It's the other way around. They would go to an opera production and have a drink in the interval. There's a sort of compare and contrast with the Mayflower Theatre case from 10 plus years ago, where Mayflower were successful in arguing that the costs of producing or the income from programme sales supported some partial recovery of production costs there. And the court said, yes, that's fine, because the programme content comes from the productions. There's a very clear link between them. But they did comment at the time that it was good that they hadn't tried to argue additional recovery based on catering sales and ice cream sales, because that would have been a step too far. But again, it goes back to the Frank Smart case that we talked about with farm subsidies, that there's got to be a direct and immediate link between the expenditure and the taxable income. So, and also clearly with Sveda made the same point. So, what does all of that mean for charities? It means it can be a bit of a minefield, to be honest, and that HMRC keep plugging away at this. And a couple of my charity clients in the last few months have had HMRC probing at whether there are non-business activities and whether that should lead to a restriction to input VAT. Recently, I had a charity that had a very large grant in order to refurbish a cafe, but we successfully argued that the VAT was fully recoverable because the cafe generated only taxable supplies. The fact that the expenditure was supported by a grant was immaterial. Why should it make any difference whether they use a grant versus their own reserves or bank lending or whatever? It shouldn't make any difference. So, these things are quite complex, and HMRC is certainly probing around in this area. Moving very briefly, just on my final slide, I haven't really got time to comment in any detail here on these things, but it's just a reminder that if you are changing your activities and maybe having a trading subsidiary and so on, you need to be mindful that any charitable VAT reliefs that you might get for building work, for example, or the exemption for welfare services won't necessarily or is unlikely to apply to a trading subsidiary. So when you're working out how to structure things, you need to bear in mind that there might be a different VAT treatment and whether to VAT group or not. And that concludes the VAT section. So I'm going to hand you over to Gareth now for the next part of the session.
Thanks, James. Yes, so I'm going to talk briefly on gift aid, moving on to look at some developments and some practical planning points. Starting on some background though, so gift aid, or the world's greatest charitable tax relief, as it was rather grandly described by the Charities Aid Foundation in 2015 to mark its 25th anniversary. Obviously, that's probably open to debate, but I think what there isn't any doubt about it is how important it it is to the sector. In 2019, there was £1.35 billion of gift aid claimed by charities, making it second only to rates relief as the most valuable tax benefit to the sector. But simple and effective on the slide, because that's, when you look at charity websites and HMRC guidance, it's an expression that comes up time and time again. And it's easy to understand why, in large part. From the donor's perspective, you tick your box and the charity gets its extra 25%. The simple element is probably, as you know, overstated though. HMRC's detailed guidance for gift aid, the so-called Chapter 3 guidance, if you were to print it out, runs to 70 odd pages of closely typed guidance. And even there, there's frequently complaints that it lacks detail, and so can lead to HMRC officers taking different perspectives and giving charities inconsistent advice. I think part of this complexity, it relates to the way that the scheme's developed over time, with the scope of the relief being expanded, which is obviously a positive for charities, but with a corresponding increase in the related admin and the regulation. So just on some of these developments, when gift aid came in 1990, it was relatively restrictive. It was expanded, and it's essentially the gift aid as we know it now, with the changes made in the Finance Act 2000. I picked out some fairly significant changes. So the retail gift aid was introduced in 2006, which was a mechanism for turning the donation of goods into a donation of cash, which qualified for gift aid. The gift aid small donation scheme, which came in 2013, giving scope for small cash and contactless payments to fall within gift aid. And the intermediaries and online giving changes in 2017, which allowed a donor to make a single declaration to an online intermediary, so just giving or Virgin Money or whoever, and allow that intermediary then to pass on the declaration onto the underlying charities. So just looking at some of the complexities in a bit more detail, I think it's useful with gift aid to go back to the fundamental, which is that to qualify, it's a donation of a gift of money, freely made, with nothing expected in return to a registered charity or a cask. Obviously, though, the interactions that charities have with their members and with their supporters and their fundraising activities are more complex than just waiting for unsolicited donations to come in. So there's specific rules around the level of acceptable benefits that can be provided to a donor for that payment still to be considered a gift and therefore to fall within gift aid. There's some benefits which are specifically excluded, things like a charity literature, the charity magazine, access to property, naming rights, where that's an unsolicited sort of token which is given to a donor. Then there's a set of value-based tests where the maximum value of the benefits relative to the amount of the donation needs to be calculated and to fit within the qualifying parameters. But that again is complicated by the fact that the benefit isn't necessarily easy to calculate. It could be a discount, say from a cafe or something, or it could be access to a special event which isn't open to the public. So it's the valuation of that element, again, is a set of complexities. The admission to view charity properties, the specific rules there. This is where you see the extra 10% and access to a property for 12 months, which then turns payment to visits into a qualifying gift aid donation. And similarly, there's all the special circumstances such as online auctions or charity auctions, sponsored events, and the possibility of splitting a payment into a donation element and a element which is a payment for a supply of goods or services. On the compliance side, obviously there's fundamentally two sides to the compliance. There's the perspective of the donor, who must have sufficient tax to cover the gift aid being claimed by the charity. And from the charity's perspective, the compliance focuses on obtaining a suitable declaration from that donor, confirming that that's the case and that they're happy for gift aid to be claimed, and to maintain records and evidence that donations are being made and linking this to that underlying individual. There's different rules for the small cash scheme, but again, there needs to be that audit trail and that record keeping maintained by the charity. Because HMRC only carry out relatively limited checks on the submissions made, they have the right to carry out audits to check that these declarations are being obtained by charities and that the appropriate records are being maintained. And if that isn't the case, the power to force charities potentially to repay gift aid that's been paid out to them. The last point, the tax gap. This concept, it goes back to some research that was carried out a couple of years ago now, which suggests that 25% of donations made to charities that could have potentially been gift aided weren't. So that equates to around £560 million of gift aid which isn't being claimed. But conversely, on the other side, that 8% of claims being made and where gift aid was paid weren't actually eligible, so that the donor hadn't paid sufficient tax or it wasn't a qualifying payment. So this sort of links back to those complexity points about what qualifies for gift aid and the admin demands, some of which may be putting off smaller charities from claiming, and a misunderstanding or a lack of information provided to donors, to charities. Moving on to look at some of the recent issues and future developments. Firstly, just specifically in response to COVID. Initially, a push within the sector last year for a temporary increase from the 25% gift aid uplift as a response to the funding pressures faced by charities. That obviously didn't happen, but there are a couple of specific reliefs that have been given. One is around where events couldn't happen and where the right to that refund is waived. That can be turned into a gift aidable donation. There doesn't need to be a cash repayment and that go back. And similarly, where an individual has made a loan to a charity which it decides to waive, that can qualify as a gift, and so subject to gift aid. There's also been some minor relaxations around admin, particularly on the retail gift aid scheme, where previously there's a fairly set reporting date to report on amounts sold on individuals' behalf. That was relaxed as a response to the pressures of COVID. In terms of looking forward, though, so the Charity Tax Commission, this was set up by the NCVO in 2017 to look more broadly, really, at the interaction between charities and taxation and tax legislation. It reported in 2019, and specifically in respect of gift aid, its key recommendations were that the higher rate tax relief from gift aid, which obviously at the moment goes to individuals, that as a default that should be redirected to charities. And the second one was the introduction of a universal gift aid declaration database. So this is where donors would register once with the database, and the charities and HMRC would access that directly. And it's felt that would simplify the admin process and address that tax gap issue that we spoke about. The Charity Tax Group, they have a Future of Gift Aid project, which is largely trying to carry forward some of these Charity Tax Commission recommendations, particularly around automation and the idea of a universal declaration, and ways that gift aid details can be linked back to HMRC or bank data. Again, these are seen as ways to address the tax gap and to minimise gift aid that's missed or claimed in error. But that's obviously fairly future looking, but back to the here and now. I thought I'd just finish off with some practical steps and planning points. The first one, it's a fairly obvious one, but systems are obviously key, ensuring that the charity has appropriate systems and controls in place to capture the relevant information, and that volunteers and staff are aware of the gift aid rules. Regular review. I thought internally, it's things like monitoring new income streams and fundraising initiatives. As James touched on in his presentation, a lot of charities have had to pivot and sort of change some of the way that they've done things because of COVID, and see if that has potentially implications for gift aid. And also, as I spoke about earlier, it is an area where there's frequent changes in legislation, changes in HMRC's approach. So within the charity, that is monitored, and where there's opportunities, those are followed up. So whether it be useful to have it as a recurring agenda item for the Finance Committee or similar. On claims for earlier years, just remember that claims can be made for up to 4 years from the end of the charity's financial year, or 2 years for the small gift aid scheme. And also that a donor can retrospectively put their declaration in place, again, for 4 years. So there's the possibilities of claiming relief from earlier years. The point on the understanding of the possible negative consequences, this is specifically thinking about things like retail gift aid, or where a supply is split between a donation element and a payment for a benefit, which can potentially trigger a VATable supply. And it's just understanding the possible implications of that and the cost benefits. And the final point is just engaging with donors to make it clear to them how important gift aid is to the charity, and so that and to address any concerns that they may have. The Charity Finance Group, for a number of years now, ran a gift aid awareness day where they generate resources and publicity. So it might be useful to engage with that and use some of that resources for your organisation. It's on the 7th of October, if that's of any interest. So that completes my section. I'm going to hand over to Linda now, who's going to speak about some charity governance issues.
Thank you, Gareth. So just to round off this morning's webinar, just some highlight points on charity governance that you need to be considering as you move forward. The accounts monitoring review was carried out in 2019, and the follow-up from that is really looking around the incomplete recording of related party transactions in financial statements. Charity Commission are heightening this and making sure that there is correct disclosure in the financial statements. This is to try and give the public the confidence in what charities are actually saying about the sort of transactions they carry out with trustees. I think the area where they find the reporting is maybe lacking is probably around close party relationships with trustees, and not necessarily picking up those transactions. So it's making sure that organisations have the relevant systems and controls to be able to pick up that information as they go along. The second one is not providing a separate summary income and expenditure account. And this is a Companies Act requirement for those corporate charities. And very often this is just included in the SOFA if the SOFA has been presented in the correct way. But what they're not seeing is that maybe in the heading of the SOFA, there isn't a brackets, including income and expenditure account bracket, added after the title. So that would be a really quick win. But when they review the 296 sets of accounts that they did this year, in 2019, then that wasn't always evident in some financial statements, and therefore that's reported as not being there. So just something to watch out for when you're pulling together your financial statements in the current year. Moving on, 2021 sees the 5th anniversary of the Fundraising Regulator being set up. So what have they done over those 5 years? They have worked with 12,700 people managing their fundraising communications with charities. And I think we've all seen some of that and the questions that we're regularly now asked to make sure we've recorded what our preferences are. They've worked with 5,000 organisations to show that they are committed to ethical fundraising. this is really important in the public domain to encourage people to donate to charities and not to feel maybe intimidated. Of the 2,500 complaints that they've received, they have carried out 200 investigations. I thought that was very interesting because then they are getting a balance between not investigating every complaint, but really assessing whether there is an issue that needs to be undertaken with a charity, and then really looking at those complaints that do lead to that investigation being required, and helping charities to understand why that investigation has been necessary. There's been 5,400 inquiries tailored to giving specific advice to charities or the public on fundraising activity and how that can be tailored to their organisation. And they have now got 2,700 smaller charities registered with them. So I think overall in the past 5 years, that's been very positive. I think the main driver that they've had in the 5 years is to look at the fundraising code, to make that more understandable and to digitalise that so it's much more easily accessed. And then finally, we now have a SORP developments committee that has been set up, and they are looking at how the SORP can be more aligned to FRS 102. Interestingly, in May 2021, the charity regulators in England and Wales, Scotland and Northern Ireland all joined together to write to the Financial Reporting Council to ask them to look at FRS 102 and its applicability to the charity sector. Whilst they completely understand why FRS 102 was necessary to align UK GAAP with international financial reporting standards, I think the feeling is that it isn't really helpful for the charity sector. They've also, the Charity SORP Developments Committee have been asked to think about small charities first and to maybe consider the threshold for smaller charities because they feel that there is a lot of pressure put on charities to do a lot of financial reporting that maybe isn't appropriate for some of our smaller charities, of which there are many registered with the various regulators. So the areas that they're going to be looking at, narrative reporting, there's 15 areas in total covering these 4 headings. So narrative reporting, that's around impact reporting and how that focus can be enhanced in the future, and maybe looking at more areas like diversification and diversity reporting. And the Charity SORP Developments Committee are hoping to give clearer guidance on what charity reserves should be. Within expenditure, that's around support costs and improving that compatibility, and looking at tackling the problem of the negativity that people see around overheads of a charity. They're also looking at the expenditure classification and the activity reporting because they feel that that's particularly misunderstood by some charities. On the income side, it's around grant income, donated goods and services, and legacy income. I don't think that's going to be a surprise to any charitable organisation that they're the areas where people struggle to understand how that income should be recorded. And then on the presentation, it's around the length of the presentation that needs to be in the accounts, clarity on funds notes, and around materiality for the larger charities to present a much clearer message within their financial statements. So that concludes our webinar this morning. I'm now going to hand back to James for questions and answers.
Thanks, everybody. We've covered a lot of very important technical areas this morning, so thank you for that. We've just got time for a couple of quick questions, if that's okay. We've had a few come in via the portal. Just first question, asking about corporate gift aid. Gareth, could I point that question in your direction? Just asking if there's been any developments on that front.
Not in terms of legislation. A couple of years ago, the slightly odd situation, it was confirmed that for a trading subsidiary that gives to its parent charity, that donation for financial reporting for sort of governance purposes is a distribution as opposed to an actual donation, which had implications in terms of reserves, but for tax purposes, it remained a gift. So hopefully most charities should have gone through the sort of cycle with their accountants and auditors to sort of address any issues with that. I think the only other thing with corporate gift aid is obviously corporation tax rates are going up. So it may be a potential area where charities can look at corporate fundraising and sell it as a tax planning part of the mix for companies.
That's great. Thanks, Gareth. Just time for one more question, I think. James, it's one for yourself, I think. Asking, if we're a charity, will all our activities and income be charitable and therefore be regarded as non-business?
There's not always not necessarily a direct read across that just because your activities are within your charitable purposes, that automatically makes them non-business. Think of examples. I've seen cases where very often it doesn't really make any difference, because whether the income is non-business or is regarded as business income but VAT exempt, it doesn't matter. There's still no VAT on the income and you've got no VAT recovery, but it might be important. So for example, I mentioned welfare services earlier. I've had charity clients that have contracts to provide welfare services. Well, that is business income, but VAT exempt rather than non-business income. And it can have an effect if you've got a situation, for example, where you're going to buy a property and you want to disapply the seller's option to tax and say, actually, we're using it for a non-business purpose, but actually, if it in VAT terms, it's a business purpose, but VAT exempt, you can't disapply the option to tax. So I think you have to look carefully at each situation, but it doesn't automatically follow in answer to the question that just because it's a charitable activity, it's non-business.
Thanks, James. I'm afraid that's all we've got time for today. Thank you to all our presenters, and thank you to the attendees as well for making time to attend. A reminder that the webinar has been recorded and will be available on our website shortly at brownbutler.com. Thank you. Goodbye.